When it comes to estate planning, one of the most common questions we hear is, should I use a will or a trust as my primary planning tool? For families with significant wealth, this isn't just a legal formality. It's a decision that affects privacy, control, taxes, and how smoothly your loved ones navigate your legacy. The right structure can preserve your values, minimize conflict, and protect your assets for generations. Today, we'll walk through the key differences between wills and trust and help you determine which is a better fit for your estate. So Spencer, the reality is wills versus trust. It's a really common and complex financial planning conversation. I think especially because as the estate tax exemption thresholds have changed pretty significantly over the last 20 years, there's been beneficiaries that we have seen whose parents passed away who are now thinking, should I use that same trust that my dad did? But when my grandfather passed away in 2004, the estate tax exemption was $1 million. Right now it's $14 million with portability. So there's really a lot of different considerations now versus there were 20 and 30 years ago. So let's dive right in. What is the first thing that we need to talk about? Trust, avoid probate, wills must go through probate. Talk us through this differentiate.
And even before we go there, the caveat is always talk with your estate planning attorney on this. Yeah. Do not draft this yourself. Pay someone so that not only the verbiage is there that needs to be there, but also that it's executed in the proper way. You may need in your state 2 witnesses and a notary. You may need some other configuration of people. Sometimes there are prohibitions between, some people serving as that. So you need to work with an estate planning attorney because they will help you make sure that you're making wise decisions and executing it properly. We are not estate planning attorneys, but we see enough of these that we oftentimes can help frame decisions and get clients at least thinking about things that they need to as they have that conversation. So wills versus trusts. Well, first thing we want to go back to is almost every client is going to have a will. It's just, is that the primary planning document that's used? So in a case where the trust is the primary planning document, you would still have a will that would say, okay, anything that I forgot to title towards a trust, I'm now formally pushing towards that trust. Almost every time we still want to have a client have a will, because if there's something that they forgot about or they didn't title correctly, at least the will then is going to have that pour over capability and push everything back to the trust. If there is no will and there's some asset like that, then things can get fairly dicey fairly quickly. So with those cautions, we think about this really at the most fundamental level is, do you want your assets to go through probate, or would you rather than have them pass outside of probate via a trust? And there's a lot of different trade-offs, especially in the state of Tennessee, where probate is fairly straightforward and fairly inexpensive. We have a lot of trade-offs. In a state where we might have, in the Northeast, if we have a client in Connecticut or had a client in New York or one out in California, we would look at this in a little different light because the expense of moving through probate can be much, much higher. So a trust might be much more attractive in those states. In the state of Tennessee, because we have a fairly straightforward process with probate, we've got a lot of different options.
Yeah. So expense is one consideration. Privacy is another. Do you want to talk us through the privacy aspect of a trust?
Well, probate is public. So if your assets go through probate, essentially it's going to go before a court. They're going to read your will. They're going to name an executor or executrix, personal representative, to be able to manage the affairs of the estate. But that's going to be public. If you have a trust and if everything is set up properly and retitled to the trust properly, oftentimes that is not going to be visible to many people at all. So there are times that trusts can be contested, and so it's not a magic bullet that cures everything in all situations, but it does make it a lot more difficult for people to know what's going on within the context of that trust. So that's the biggest thing is, do you want this to be public? And sometimes it can even be helpful to be public because you say, okay, well, we're going to deal with this once for all. Resources are going to go through, probate process. We're going to have the will. If there's a contestation, at least everybody knows, what's going to happen, with that, and it's public. So there are people that even choose to go through that process because they know that it's going to be a little bit dicey. Most of the time, though, if we have a client that knows things are going to be a little bit dicey, they'll go towards a trust and they'll keep things in more of a private set of circumstances.
Right. So the next point is trusts offer greater control of how and when resources are allocated. And the reality here, I think we need to take a step back and say, what resources are you passing? Because if you're passing an IRA, a Roth IRA, your non-qualified account, beneficiary designations are going to supersede what is written in the will. And so really, we got to be thinking, what are the assets that you're passing that you need to control that timing and distribution? So can you walk us through some of this aspect?
Well, for a lot of our clients, it's fairly straightforward. Like you said, they will have beneficiary designations on all of their investment accounts that will go direct to their preferred beneficiaries. So that's not even moving through probate, to your point. Now, they can designate that those assets go to their estate, or even that they go to a trust that's set up under the will. So there's all kinds of different complexity that can be used here. But we want to come back to the idea that a lot of assets aren't even going to go through probate in a normal set of circumstances. Trusts are really, really helpful if we want to be able to control how those resources are distributed over time. And we want to put some guardrails around those. So let's just say that you have a minor who is a beneficiary. You'll want to set up a trust so that you name the trustee and make things really crystal clear for the courts, because your minor cannot be a beneficiary who can make decisions. So you know that 12-year-old is not going to make decisions on how much is distributed from her beneficiary IRA. Right. There's going to have to be a decision maker above her that would be a guardian or that would be a conservator, and you don't want the court to name that person. So you want to go ahead and think through, okay, is there a potential that I will have a minor who is a beneficiary? If so, it would be great to have, it could be even within the will, a testamentary trust that would say, okay, if a minor becomes a beneficiary, then assets are moved to this particular trust, and here's the trustee, here are the ground rules for distribution, so on and so forth. So trusts offer that greater control over how and when assets are distributed. Now, it could be a situation where we have a spendthrift consideration, where we have one heir that money just moves through their hands very, very quickly, and they don't necessarily make great decisions. Well, a trust in that set of circumstances can also be great, because it can say, okay, well, you can only have, say, 5% per year, or you can have, the required minimum amount for a period of time, and then, 5 or 10 years down the road, you get a lump sum, and then, you have another period of time and you get another lump sum. However you want to set that up, a trust is really a choose-your-own-adventure type of document that allows you to put in place all kinds of different provisions there, speak beyond the grave, and make sure that you're doing your best to put some guardrails around a beneficiary if they need that.
Right. Okay. So the next piece is asset protection. How do we need to think about protecting assets for future generations?
Well, in our litigious society, you can sue anybody for anything at any time. It certainly feels like that.
Yeah.
And so you will have people that if there is a wreck on the interstate and their attorney finds that, your son or daughter, your heir has resources that they could come after your heir for a lot of money. Let's just say that you have an IRA that is in your name. Let's say it's $1 million and you rolled that over from a 401k to a traditional IRA. Generally speaking, there is creditor protection on that during your lifetime. You are the owner. You contributed to the 401k originally. Those were pre-tax dollars. You move those over. There's creditor protection. When you name a beneficiary who is not a spouse, a son or daughter, let's just say, as a beneficiary on that, maybe a contingent beneficiary, and they receive those resources, the courts to this point have not looked at those assets as being protected from creditors. So again, that accident, heaven forbid, that happens on I-40, you could have someone coming after them for the resources that they've inherited. Now, if you push those resources and instead of naming your son or daughter as the beneficiary, you name a trust, and the trust has them named as a beneficiary, why, then you have some creditor protection. there, because all of a sudden the trustee does not have to make distributions to your son or daughter, and everyone is aware of this. Actually, your son or daughter does not own those assets. They are not they are not in control of those assets. It's the trustee that's in control. So in that circumstance, you do have creditor protection, and that could be from any number of different things. It could be from a wreck on the interstate. It could be from a bad business decision where they become a partner in a business that goes under, and not only goes under, but has certain liabilities that creditors come after them for. So there's all kinds of different things that could be applicable here. It's unusual that those protections help, but in certain circumstances, they can defend really the entire amount there that would be otherwise taken by creditors.
Right. Well, and I think the big question here is, to what extent do you think that this is a potential problem? And we can't see beyond the grave, but this is maybe allowing us to try to speak beyond the grave. But there, even as you were speaking, I'm hearing, well, if my son or daughter gets in a wreck on the interstate after I die, there's a lot of ifs and ands to really consider here if you're going to push resources into a trust in this regard.
Well, and the trade-offs are significant on the other side as well. So we have first, one of the things is that it's just more inconvenient. You know, you think about the process of putting together an estate plan and writing a trust, or having your attorney draft a trust. Usually there's an additional expense. Usually there's a lot more considerations and things to think through that you've got to decide on. In addition, usually you have to retitle resources. Sometimes this retitling can be quite frustrating. So you might retitle a non-qualified asset as owned by the trust, which is fairly simple and straightforward. But sometimes, like if you have an IRA or a 401k, you would need to submit a updated beneficiary designation. From our experience, sometimes this goes very smoothly, sometimes it does not. If the trust is rather complex, sometimes the custodian is going to say, no, we don't really want to allow you to name that trust as a beneficiary because there's too much complexity in this beneficiary designation. So sometimes we'll go back and forth with the custodian on that. So there's just more difficulty oftentimes in naming a trust. And then the final thing is, if you have a trust and you set that up and let's say assets go there, they don't go direct to the beneficiaries, the trust is a legal entity and you have a tax filing that's due for that trust on an annual basis. So I know everybody loves to file their own tax return. Well, now you get to file a trust tax return too. The trustee gets to do that. So if you are the trustee of of a trust that you are also a beneficiary on, then you can keep that fairly straightforward in that, you know, maybe you go and you work with your CPA on 2 tax filings. But if you have an independent trustee, you know, then that is managing that, then that trustee needs to do all the different things to file that tax return, and there's an added expense here. So again, if it's fairly simple and straightforward, you have a beneficiary who is also the trustee of his or her trust, then you may not have that added expense. But let's just say that you have a beneficiary who's not able to serve as the trustee for whatever reason, and now you're hiring a corporate trustee. Why, that is expensive. There's an expense to that. Whether you're paying an attorney, whether you are paying a trust company, you know, to do that with a trust officer, there's a level of expense to that. If you instead name a family member as the trustee, then that can put the family member who's the trustee and the beneficiary at odds. That can create friction there. So it's not as though there's an easy path where you check off all of the different boxes. Regardless of what you read online, there's so many different online articles that say, well, the trust route is the only way to go. There are benefits there for sure, but there are also drawbacks in the amount of time, the amount of money, the amount of complexity that you introduce with a trust, which can all be worth it in some situations and in others, maybe not.
Well, and to your point, if trusts need to pass through all of the income that they generate, or they have really high taxes that are due. So let's just say you have a trustee that mismanages the trust, doesn't push out a distribution as they're supposed to. Well, if you are at a tax rate of maybe 15%, your tax rate may be doubled or even more than that, depending on your state and local taxes as well. So again, there's a lot of hurdles that we need to be aware of if we're going to go the route of the trust. So the last thing we want to discuss is just the complex situations where trust may make sense. Can you talk us through that one?
Well, certainly anytime that we have a special needs beneficiary, a trust can make a good deal of sense, because a trustee basically is going to make distribution decisions and say, okay, is this going to be in the best interest of this beneficiary? Where this can have the biggest impact is they might not make distributions because a distribution could remove benefits at a federal or a state level to some beneficiaries if they have too much income, or if they have income in certain ways. So a trustee, if assets go into a trust, the trustee is then able to oftentimes look at the trust document and then make some wise decisions about what needs to come out, what does not need to come out, because it can be a tremendously bad decision to have resources just go unfettered, unencumbered, just right to that beneficiary and disqualify them for all kinds of different medical benefits and other benefits at a federal and a state level. So that can be a huge piece of why we need a trust in a particular situation if there's a special need for a beneficiary. Of course, the other one is what we've already talked about. If you have a minor who's going to receive assets, you need a trust, because why don't you go ahead and decide who's going to be the trustee and the terms of distribution and those kinds of different things, rather than the government needing to step in and say, okay, we're going to name this conservator or this guardian, on these funds here. So that's far more efficient, and that's where actually a trust can save you a fair amount of money, is because if you have to move through the courts to do all those kinds of things, the attorney is going to make money one way or another. They're just going to make a lot more money because it's a lot more complex situation if you haven't already set up a trust to receive the assets that a minor would be receiving in the inheritance.
Yep. Anything else you would say on the special needs trust or trust in general?
Well, trust can also be helpful really when we see clients who have blended families. So if we have beneficiaries, let's say mom has 2 children from a different marriage, dad has 2 children from a different marriage. Oftentimes a trust can be set up for each of their assets. So mom predeceases dad, then let's make sure that if mom's assets need to be available to dad during his lifetime to care for him, that they're available, but otherwise those resources go to her children. And the same for dad. That can help really with that clarity that families oftentimes desire, so that we actually reduce the level of friction and we bring transparency to an entire process. If instead we don't have a trust in place there, and let's just say it's very simple and assets go to the survivor, so all of mom's assets go to dad, all of dad's assets go to mom, there's no trust in place, then each of them is basically relying on the survivor to do the right thing and make a decision that would be in line with their own children's not being disenfranchised there, which sometimes that happens, but sometimes it doesn't. And one of the saddest things is sometimes it doesn't happen because the survivor ends up having dementia or some other cognitive decline, and they end up making some decisions towards the end of their lives that change what was agreed upon. And that's not a good situation, but it's difficult to avoid if we don't have a trust in place for the first decedent's assets to move through.
Great. Well, Spencer, thanks for walking us through just some of those considerations that we need to think about with end-of-life planning. As always, clients, we would love to talk with you about any of this stuff, whether a trust makes sense for your estate plan or not. As always, we cannot draft these documents. Always work with your estate planning attorney to make sure those draft documents are drafted in alignment with your desires. Feel free to leave any questions or comments down below, and we'll see you again next time. Take care. If you like these financial planning videos, please share with a friend, and if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.